this is just my opinion on it because I've been pre-COVID, post-COVID, and that changed things to some degree. So traditionally, in the private equity space, you want to build a contiguous acreage position, and you want to drill 5, 10, 15 wells to go ahead and de-risk all the acreage or as much acreage as you can that you secure, and then move to market or to try to sell it. I think that throughout my roughly 18, 19-year career, I've seen oil prices hit 100 3 times, 4 times, maybe 3, 4 times. So it's interesting looking at, pre-COVID when oil hit 100 and the rig count across the lower 48 versus the way it is now. When it looks like we're approaching 100. We may not get there, but we're above 90 today. So today we're sitting at, between 670 and 680 rig counts in the lower 48. We've seen times in the past where oil is approaching 100. There's 2,000 onshore rigs. So for a period of time that a lot of management teams had access to capital to go ahead and build out that model that I described. That was more pre-COVID, where you're building organically and you're drilling wells, and there's capital to drill wells and to take a little bit more risk with stepping out in a certain area within a play and de-risking your acreage. And so it was very much growth through the drill bit with a 3 to 5 or 7 year plan to monetize. Post-COVID, the source capital, it's become a little bit more difficult, just because we had experiences where we've drilled ourselves into, the industry has drilled itself into a little bit of a dilemma, where the wells or the program is not successful, the resource isn't there, and I think capital has noticed that. So now what I'm seeing is that capital is still somewhat available to the oil and gas space, but most of the wells that are being drilled as part of that 670, 680 onshore rigs, it looks like to me it's mostly infill drilling. And when I say infill drilling, it's where you've got a drilling spacing unit, I call it a DSU, that has a parent well, whether it's drilled 2013 or 2020, and it's a good well that you're going back into that unit and you're filling in those sticks, and you're drilling additional wells within a unit that there's very little subsurface risk and or very little commercial risk. So I don't see a lot of, I would say pure exploration dollars in any play right now. So it's very concentrated, very disciplined drilling, or companies are being very disciplined with their capital. And that's on the private side and the public side. And what's interesting on the public side, and this has gone on for the last couple of years, is really where they're drilling their best wells first. And if a well doesn't meet a certain internal rate of return, let's call it 25 or even 50%, then that well's not being drilled. The excess cash flow that's the program or the company is making, it's going back to shareholders in the form of dividends and or stock repurchases. So more money is being given back to investors and to shareholders. And so that's kind of the lens that we're looking through today. Is it's more disciplined. It's very much more focused within specific areas or specific units versus more of the broad brush. Here's the outline of the play, and we can drill across any DSU section within the outline of the play. And that's not the case now.
Yeah. Is that same lens something that you kind of foresee staying for a while, or do you think that what is the next iteration? Maybe if you had to guess, right? If you're just kind of forecasting and seeing trends and how it might turn out.
I think companies are going to continue, whether they're private or public. I think they're going to continue to try to finance their own drilling operations through cash flow. I think that is that's the motivation now. And we're in a boom and bust industry, so we've seen a lot of price spikes and a lot of dips. During COVID, we saw for a day negative $34, $37 a barrel. And I think that capital sources have taken notice of that. But there's some external factors that are driving the price of oil too, that people are looking at and waiting on, like the the lollipop production cuts out of OPEC, and I know Saudi is their production has dropped pretty substantially. Iran's production has actually increased, and so we're seeing that in combination. I mean, it's to me, it's not. We're in a $9 oil environment, not so much from the demand side, from the supply side. So we're still very much undersupplied for the most part. With there's just there's no new plays being discovered. There's not a lot of additional production being brought online, even though I believe we're still producing about 12 million barrels a day, which is a global leader. The U.S. is, but that's and to the demand side is that we're seeing demand numbers out of China. They're not as strong as what we anticipated. And even post-COVID now, I think we're still seeing the effects of a lot of people working from home, and not working from home 5 days a week, but maybe 1 or 2 or 3 days a week they're working from home. They go into the office 2 or 3 days a week. So their normal route that they usually drive, that's being taken out. That's out of the equation. So just to touch on, I think people are watching that type of data, global data, come out to see where prices are going to go. It's a very interesting time in both the public and private equity space.
Yeah, we've got $90 oil, but it feels more like 60, doesn't it?
It's felt like that for a couple of years, to be honest.
Yeah, it has. And also, just to one of your other points, and Harold Hamm talks about this in his book a little bit too. The day of the wildcatter there are no wildcatters really anymore. You have some small producers, some small companies drilling shallow wells, but even they know what they're going to get. Going into a new area where, like the shale plays, they thought they had it figured out. They didn't know until they drilled a few wells and refined. It didn't take 1 or 2 wells. It took several wells and to refine that process, and they're still doing it today. But the day of the wildcatters gone. It'd be nice to see that come back at some point. And I know there's a lot of guys like Harold Hamm that would love to do that. But as you said, it takes capital. And I think that's one of the reasons why Mr. Hamm, I'm going to call him, why he went private with his company. And he wants to do more out of the box things at this point.
Right. That he also had the benefit of owning over 7% outstanding shares too.
Yeah.
So that helps. But I think that it's this industry is so unique, and there's so little content out there on it. I think there needs to be a lot more. But we talked about the Barnett, Fayetteville, Haynesville, the Marcellus, and we really didn't find an oil, let's call it an unconventional oil play or a shale oil play, until the Bakken. And the Bakken really opened things up, coupled with the Eagle Ford. But that to me, that was the game changer. Is once we can start extracting oil from tight shale formations, it's one of the reasons why Heritage is in the Bakken, just because there is a lot of resource in place that has not been drilled yet, for the most part. So there's still areas, I believe, in the lower 48. I know that there's areas in the Bakken. There's certainly probably some areas in the Eagle Ford and the Scoop and the Stack. Even though the Scoop is probably a little bit more of a NGL, high volume gas play with associated oil, but there's still areas that are very prospective, even at $70 oil. So you have to sit back and ask yourself, well, like, why aren't these townships, why aren't these sections, why aren't these units being developed right now? And to me, that's mainly because companies are being much more disciplined with their capital than they were pre-COVID, or let's say 2013, 14, or 2017, 18. So it's definitely an interesting time.